That's telling us that the bond market is saying recession and or big surprises on the low side of inflation expectations.
Have you been paying attention to the recent news about inflation and the Fed's response? The decisions being made right now could have a major impact on your financial future. Cathie Wood shares her view and compares our current times to the inflation problem from the late 70s and early 80s. Let's hear what she has to say.
Well, if you look at what's happening in the pipeline, what you're seeing in terms of commodity prices are some very serious declines, both from their peaks and year over year now. So that is sort of, we would say that's upstream inflation that is heading towards the PPI and then ultimately the CPI.
So what I think we will look back in history and say, this inflation shock was the function of a supply shock caused by COVID, supply chain problems afterwards, and even more problems after Russia's invasion of Ukraine.
Wood's concern is that the current inflation is not transitory, but rather a symptom of a more significant problem. This problem includes the overstock of inventory around the world, particularly in the United States, where companies overordered and have too much inventory sitting on the shelves.
The second thing that we're looking at is the inventory glut around the world, and especially in the United States. It looks like some of the best supply chain managed companies in the world have over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double-ordered, triple-ordered, so that Nike, for example, its sales were up only 3.5% globally last quarter, and yet its inventories were up 44%. And in the United States, they were up 68%. And if you look at in transit, they're up 85%. So that's just one indication. We're seeing lots of inventory overhangs, and even online sales are suffering. Amazon just had its second Prime Day, and it showed no increase, which is really from a year over year, which is telling us that either units are down or prices are down. So I think the CPI that we got today is a lagging indicator. It always is a lagging indicator. And we're seeing a lot of prices in the pipeline that are falling.
Wood's analysis suggests that the current CPI is a lagging indicator and that we're seeing a lot of prices in the pipeline that are falling. This issue is further compounded by the recent decrease in gold prices, which is a leading indicator of inflation.
We've got gold prices. And in fact, I looked at them yesterday. I had thought that the last 2 years, gold had been trading within the $1,700 to nearly $2,100 range. And that's true. It has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011. It was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big burst, a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation.
So what does the Federal Reserve think of all this? Cathie Wood believes that the Fed's response to the current situation is inadequate, and their policy is more similar to what Chairman Volcker did in the late 70s and early 80s, when he was fighting an inflation problem that had been building for 15 years. However, the current inflation problem has only been around for 12 to 15 months.
Yes, as we're thinking about this question, we compare what Chairman Powell is doing to what Chairman Volcker did in the late 70s, early 80s, when he was fighting an inflation problem that had been building for 15 years. Vietnam War, Great Society, closing the gold window. That was a real inflation problem that built up over 15 years. This inflation problem has been 12 to 15 months. By the time the Fed started addressing it. And we think it's much more a function of supply chain imbalances caused by COVID, and then again, by Russia's invasion.
Wood thinks the current supply chain imbalances caused by the pandemic and the recent invasion of Ukraine by Russia have contributed to the current inflation problem. She also believes that the Federal Reserve's response is inadequate and may lead to a shock to the system with ramifications for the economy, including a slowdown in housing markets.
Ukraine. These are very, very different circumstances. So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%. And that's a 16-fold increase. What did Volcker in the early 80s? He took interest rates from 10 to 20%. That's a twofold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. And I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained.
The Fed's interest rate increase is significantly more dramatic than what Volcker did in the early 80s. When Volcker took interest rates from 10% to 20%, it was after consumers and businesses had gotten used to dealing with inflation and working around it for over 15 years. As you can see, inflation is just one of many factors that may be impacting your financial well-being. How has inflation and these other factors affected you personally? Have you noticed any changes in your spending habits or job opportunities? We'd love to continue the conversation. Share your thoughts in the comments below. As always, consider subscribing if you enjoyed this content, and click the notification bell for more updates on future videos just like this one.